In this episode, we speak with Sanjiv Das, co-founder and president of Pagaya, a financial technology company that enables financial institutions to expand access to more customers through an artificial intelligence network. Pagaya evaluates and approves loan applications in real time on behalf of banks and lenders, and pairs that underwriting with a funding solution that can move approved loans off a partner's balance sheet. Sanjiv joined Pagaya as president in 2023 and oversees strategy and growth across the company's commercial business, including its single-family rental business and Darwin subsidiary. He brings more than 30 years of experience across consumer banking and capital markets, including CEO roles at Caliber Homes Loans and Citi's mortgage division, and senior leadership positions at First Data, Morgan Stanley, American Express, and Bank of America. I am your host, RJ Lumba. We hope you enjoyed the show. If you liked the episode, click to follow.
RJ Lumba is the executive chairman of Market Insight Media and managing partner of GrowthCap. He is the host of Key Executives, a podcast for driven executives and business operators. Our podcast covers all topics related to effective business leadership, from strategy and culture to products and services to sales and marketing and everything in between. In the minutes ahead, we'll share with you unique insights and tactics from some of today's most accomplished and inspiring executives.
Sanjiv, thank you so much for taking the time to chat with us today. It's a delight to be with you.
Good to meet you, RJ. Thank you for having me.
I thought where we could kick off is a little bit about Pagaya, because folks in our audience may not be as familiar with the company. And what's interesting is that over the past 10 years, as it's grown to be a dominant player in what it does in consumer lending, and a lot of that is driven by the technological changes that have happened and your ability to use AI to power consumer lending. So maybe to kick off, if you could give us kind of that overview that helps explain Pagaya.
Certainly. Thanks for the opportunity. Very simply, Pagaya is a fintech company that takes loan applications in real time and approves loans on behalf of banks and lending institutions using data and AI and a lot of predictive analysis to appropriately underwrite a loan, which is basically approving a loan or rejecting a loan, but it uses vast amounts of data and predictive analysis to approve that loan. And it does it on behalf of the lender. And while it approves a loan, it also helps take the loan off of the lender's balance sheet. So it offers not only a lending solution, but it also offers a funding solution. So in that respect, it is different to just a regular fintech that uses AI. It also gives it great capital markets execution. So let me give you a simple example. Let's say you, RJ, apply for a personal loan to JP Morgan Chase, and you apply for a personal loan for $10,000 online. JP Morgan looks at your FICO score. Your FICO is, let's say, their cutoff is 750 on FICO. As you know, 750 is a very high FICO. But the bank has its own capital requirements and lending cutoffs, and they said, sorry, RJ, you're at 740. We can't approve the loan. Now, RJ at 740 is a great customer. Mm-hmm. He may be a deposit holder at JP Morgan, but JP Morgan's policy has a cutoff at 750. So what Pagaya does is Pagaya's API is embedded in JP Morgan's loan system. JP Morgan automatically takes RJ's application, says, we, JP Morgan, couldn't approve it. Pagaya, can you approve it? And so Pagaya, in milliseconds, approves or rejects the loan based on Pagaya's data. And the loan gets approved as a JP Morgan loan to RJ, even though it was approved by Pagaya. And because JP Morgan is not willing to take a less than 750 loan on its balance sheet, Pagaya takes it off its balance sheet, securitizes the loan, and sells it to private credit and private investors. So net-net, the value to JP Morgan was that they approved a customer's loan. They didn't take the risk that they had their minimum cutoff on their balance sheet. By the way, they end up servicing the loan after you've taken it. So they keep the customer and we keep the asset. That's the best way to understand it. So it's great for consumers because all of these customers who don't get loans from mainstream banks would have gone to payday lenders and would have paid a 300% interest rate. Or,
Mhm.
I mean, it's unbelievable what the loan sharks rates can be. So
Mhm.
Pagaya offers this as a full service to banks and lenders. And today it originates $10 billion worth of those loans on behalf of 30 lenders.
I had not realized, and I was looking at one of your company presentations, that I think the percentage of people who are typically not approved is around 42%. Maybe they're not approved or they are not approved by traditional banks.
Yes.
And as you were mentioning, the alternative is very high interest rates. Was that gap in the market, had that always existed? I mean, it seems astounding that before Pagaya entered this market, that a lot of these borrowers were left with just slim pickings of lenders who would charge very high interest rates.
Very much so. I mean, the whole industry of payday lenders is because mainstream lenders like banks and several non-banks, like even monoline lenders, would not approve loans because of generally a lot of regulatory pressure on them. So perfectly good credit, mainstream America was not getting mainstream lending.
Hmm.
So mainstream America went to marginal lending, and the marginal lenders, the whole payday industry started because I feel that mainstream lenders could not lend to mainstream consumers because of regulation, not because of credit. These are perfectly good credit people. I mean, more than 4 out of 5 consumers that we approve perform phenomenally well. And for the 1 out of the 5 that don't perform that well, we charge a slightly higher interest rate. So just to make it come to life, if a bank would give a consumer a loan at, let's say, 14% for a personal unsecured loan, we might offer that loan for 18% because we think the risk is higher. We can price up the risk. And if that consumer performs well, then that higher interest rate that the consumer pays, consumer's happy to pay a slightly higher interest rate. Whereas the alternative is to go to the loan sharks that could charge, as I said, as high as 300%. That's 1% a day. So the alternative of Pagaya being able to take those loans on behalf of the banks
Hmm.
and then responsibly underwrite it using data and machine learning, which is so rich
Hmm.
in terms of the value content, and supplement the credit underwriting that banks traditionally have done using static scores or sometimes even their own proprietary scores. And banks do a great job, don't get me wrong, but Pagaya is unconstrained in terms of the ability to use analytics.
Hmm.
It's constrained in terms of the ability to use data. We are very responsible in terms of how we use the data, but we bring in the best in class, highest quality, most cutting edge analytics to be able to use that data and to be able to then price that risk appropriately and then send it to the private credit markets who have all received great quality paper at extremely good yield. So that whole chain is important to understand.
Hmm. Yeah, it does seem like just using a simple FICO score is a crude way of analyzing a consumer borrower. And with your engine, you can really quickly unpack whether or not someone is a viable borrower. I'm curious if there's a way to explain how your engine, your AI platform can quickly tell in milliseconds. Is it based on more information about maybe that particular consumer? Is it based off of characteristics of that consumer that then draws on your other data sets of similar folks that have a similar profile? How would you explain how the engine works?
All of the above. So think about it this way. Step number one, generally traditional lenders use static data as opposed to cash flow or dynamic data, right? As I said, traditional lenders would use asset-based lending. How much assets do you have? How much income do you have? Are you a homeowner or not? Whereas we would use, in addition to that, we'd say, okay, why would I punish a renter? Just because they don't own a home doesn't mean that I give them a different score. If a renter shows a great propensity to repay their loans, then I should reward that borrower as opposed to punish the borrower. So we look at payment behavior in addition to income and assets. We look at cash flow in addition to static assets. So the first category is we use like a much, much richer data set.
Hmm.
Now we have our own data set. Just to give you an idea, I said to you earlier, we issue about $10 billion worth of loans every year. $10 billion is a pretty large lender for all practical purposes. Now, we are not a lender. We are enabled $10 billion lending, but we receive $1 trillion
Right.
worth of flow that comes in. And so in our systems, because we have the machines that basically process vast amounts of data, we can actually see, let's say RJ applied for a loan, we can see what people who quote unquote look like RJ in data terms, how do they tend to behave in terms of payment terms? And that's a very sophisticated analysis using machine learning and predictive AI that then takes the data and says, what do these agents look like, so to speak, right? That look like RJ in terms of data. But on the other hand, we do that in a very responsible way. And by that, I mean, generally, because regulation is so important to us and complying with regulation because they're approving on behalf of lenders, we want to make sure that there is transparency on when a loan is rejected. That's not when a loan is approved, but when a loan is rejected, you want to be able to say, okay, I'm rejecting the loan for the following reasons. Either income was insufficient or cash flow didn't make up, right? Or there's one step I missed, which is if we feel that RJ's loan is a little riskier, then I will charge RJ a higher rate as opposed to rejecting the loan. And I'll offer that option to RJ. I'll say, I can't approve this at 14%, but I can approve it at 18%. Would you like to take it at 18%? And generally, a 4% change in interest rate covers me for the risk. And you don't care as a consumer because 4% over the tenor of your loan is a very small amount. You'd rather have the credit. And by the way, we completely comply with all the usury requirements, which say you can't exceed 36%. So wherever permissible, we can go. Remember, credit cards charge in sort of 22, 24%. This is completely unsecured. People will pay a higher interest rate, right? So in addition to the data, in addition to the machines and the quality of the analysis that we do using predictive AI, we also price the loan for the risk differently. And we draw on not only other data sources, we draw on our own data source. And to us, $1 trillion worth of flow that comes in is $1 trillion worth of information flow that comes in. To us, that's extremely valuable, which is why we've gotten so good at this.
Does your data and platform allow you to understand the total amount of debt that a consumer is carrying? So it's kind of this borrower already has X dollars of debt outstanding. We cannot layer on additional debt on them.
Yes, it does. Most lenders have that information as well, but we are very responsible in making sure that we don't enable consumers to overextend themselves in terms of leverage. But yes, we do have that data.
On the other side, the funding sources, you've been very good at kind of having both sides of the equation, supply side, demand side. Can you describe, you have a lot of partners on the funding side. So maybe just how all the funding comes in so that you can ensure all this happens very efficiently.
That's a great question. The reason why the Pagaya model works so well at this time is not only because of our ability to use vast amounts of data and our ability to use technology in a very insightful way, which traditional lenders tend not to have. The other reason it works really well is because private credit and the alternative forms of funding understand the value of that. And that market is now mature and robust to be able to provide an exit in terms of that paper. And that's performed extremely well. So we've done like over 160 ABS transactions, which tells you that we have been consistently delivering these loans or this paper to the investors, and investors have done extremely well as a result of watching the quality of the loans that we underwrite on behalf of our lenders and looking at this paper, which has given them a consistent return. And so we now have a track record of almost 5 years and over 150 deals where we've demonstrated through the cycle that we've actually performed. Our underwriting models are robust and it works well. So the first point I wanted to emphasize was that it's not just the lenders, it's also the funders. And we are in the middle using machine learning and AI to give confidence to the lenders and give confidence to the funders. And just in terms of the types of funding facilities, which was your question, the types of funding facilities we have, by the way, we have over 175 investors that invest in us at any point in time. We have essentially two or three broad categories. The first and biggest category of funding is through the securitization markets or the asset-backed securities. We, Pagaya, are the largest players in the personal loan ABS market in the US. But we also participate in the auto ABS market and now in the point of sale. So Klarna and all those great clients we have on the lending side. So ABS is a big part of our business. The other big part of our business is forward flows. So to large private credit or asset managers, we will basically do a forward flow as opposed to a securitization. And that is another form of getting funded. And then, of course, the third category, there are many other categories, including potentially doing this at a QSIP level. But the private public securitization market and the forward flows are ways by which we get the funding done. And it's a very deep market.
I'd like to touch on your personal background. Before I do that, though, I noticed that the company Pagaya has been performing very well, very strong Q4. How do you look at the next, year, 3 years, 5 years? Do you see Pagaya growing, consistently over that time frame? And to what degree do you see growth expanding?
The short answer is absolutely yes. As I said to you earlier, we have about 31 lenders that we are in their ecosystem. We are like Pagaya is embedded as an API into their loan origination system as a partner to them. I'd say there are roughly 10 in the personal loans category. There are about roughly 10 in the auto category. And then there are a few in the POS category. And we have like gigantic players. Like in the personal loans category, we have Best Egg, which is now going to become Barclays Bank, US Bank. We have SoFi, we have Lending Club. Some of the largest lenders in the personal loan space are all in the Pagaya, all have the Pagaya API embedded on their platform. In the auto space, again, we have some of the largest auto lenders. We have Ally, we have Westlake, we have Stellantis, we have Exeter, we have some of the largest auto lenders, and we are now moving into the OEM space. And then in POS, we have the largest lenders like Klarna, we have US Bank's Elavon, and we're about to announce a few others. So all the big names are there, including the banks. And so we absolutely believe that we are going to grow because this is becoming an important, and you can see why, right? Banks are saying we want to approve more consumers. We can do it through Pagaya. Or we don't take any balance sheet risk because Pagaya helps us. So what's not to like? And by the way, there's a fee that we charge the consumer, which we split with the banks. So it's all open, it's all transparent. The consumer knows what's going on. The consumer is still dealing with the bank. So the value proposition is well settled. So the shortest answer to your question is absolutely Pagaya is like poised to grow. Pagaya, because of our backgrounds, and we'll talk about that in a second, we understand that markets go through cycles. You'll have feast, you'll have famine, you'll have great times, you'll have times of drought, you'll have times of anxiety, you'll have times of animal spirit. So you got to make sure that you build a franchise that is steady and growing through based on its fundamentals. And the fundamentals of our business is in how many lending partners we continue to sign up and how we make ourselves robust from a cash, capital, and balance sheet standpoint to make sure that we go through the cycles of the funding environment as well. As we often say, funding environments never freeze. Funding environments just get more expensive, right, in tough times. So that's the franchise RJ we are building, a franchise that will last through cycles, a franchise that will grow based on more and more and more adoption from our partners till we become like a central part of the ecosystem in the US financial lending system.
You have a very rich background in the financial services space. You've been with big financial institutions. You've been with private equity firms. Would be interested to hear that evolution. Where did you start out in your career? And then, your stops along the way leading you to Pagaya.
Oh, well, thanks. That's very generous of you. I have been privileged to have worked for some great institutions and to bring all that experience to Pagaya and to this new age world of where machine learning, AI, and is really going in a way that can help American consumers. I started my career at American Express and then went to Bank of America, mostly in cards, two of the finest institutions, as I'm sure you know, in credit cards. And then I went on to do mortgages at Citigroup in Australia, and I became the head of the consumer franchise for Citigroup in Australia. John Reed, who was then the CEO and chairman of Citigroup in the US, brought me over to the US. There was a mortgage crisis going on at Citi. Citi seems to have a mortgage crisis every 20 years. He brought me in to run Citi's mortgage business. I briefly went to Morgan Stanley, but I'd say that the peak of my accomplishments in traditional institutions in banks was when I was made CEO of Citigroup's mortgage business right during the financial crisis. I was brought in to fix it, and I fixed it, obviously with the help of a lot of great people, including the Obama administration and the folks in Fannie and Freddie. But Citi was the most troubled bank in the financial crisis, and I was proud to say that we fixed it. And what I learned from that crisis, I don't think any textbook or any MBA program would have ever taught me. It basically taught me responsible lending. And then I went to, after I pretty much landed Citi after 5 years, and as you know, Citi is now thriving, and I'm delighted to see it thriving. I then went to First Data, where I became the head of all of their international businesses. So I ran about 35 countries, essentially everything outside the US. And I saw the power of data for the first time. And they were the gateway to every Visa, MasterCard transaction. And you could see just the data there was a reason it was called First Data. And I could see the power of data for the first time. Not that I didn't see it earlier, but when you're when data is unleashed, what it can do. I should add that at Citigroup, I also had the privilege of working with the Los Alamos nuclear scientists who, post the Cold War, were hanging out. So we brought them to work in banks. And so I knew the power of predictive analytics and neural nets and all those things I learned way back in late 90s. Anyway, First Data was kind of a troubled company. It was owned by KKR. I was brought in along with the team to rescue it. I transformed it along with the management team, and we then took it public. It was the largest IPO in 2015. But I was number 2 there, so I wanted to do my own thing as number 1. So then I went to Lone Star, which is a great private equity firm. They had a mortgage company called Caliber. Again, it was a tiny little company. They wanted to exit the mortgage space. When I took it on, Lone Star was valued at $650 million, so very small compared to what I had done previously, but it was fun to do it on my own. After 4.5 years, I sold it on behalf of Lone Star for $2.2 billion. So that was a 4 times exit for Lone Star. So I had experienced banks, I'd experienced data, and I'd experienced non-banks. So I kind of know the whole spectrum, so to speak, of financial institutions. The only thing I didn't know was the true power of AI in using that data and how it could be applicable to consumers to improve the quality of credit to consumers. And I'm just having a blast doing that here at Pagaya because I'm seeing that being done in a responsible, powerful way. And I feel very proud to be here.
Excellent. Thank you for sharing the journey. It's truly a good kind of arc that leading you into Pagaya. We're entering the tail end of the conversation. I have 2 final questions. One is, can you tell us about a person who has had a profound influence on you?
I have been influenced by a number of people, but I would say that one of the people that influenced me a lot was John Reed, was the chairman of Citigroup. He was the first one who introduced me to the power of data and analytics, and the Los Alamos stuff was all of his, and how to think outside the box was very powerful. And who's our founder here, Carl Krubiner, and his other co-founders are doing is in that same direction. So I continued to be very enthused about the spirit and strength of entrepreneurship that someone like God is bringing. I'm learning from him. I certainly feel that I've been influenced by these 2 individuals quite a bit.
Last question. Can you tell us about a charity, cause, or other endeavor that you're passionate about?
Certainly. I have been involved in a number of charitable organizations because of my ethnicity. Obviously, I am Indian by origin, although I'm all American now. I feel that my soul is still Indian, and I feel sometimes a great sense of guilt that the country that educated me, I left it behind. So I had the sense of wanting to give back. And I have contributed to some of the charities that help the education of the poor in India. But right now, I am involved along with some of the greatest entrepreneurs in the US and folks, great CEOs like Indira Nooyi of Pepsi, CEO of Pepsi. I'm supporting the building of a cancer hospital in New Delhi. India has millions and millions of people that suffer from cancer and have no treatment. So we are going to build a state-of-the-art hospital, and which is going to cost about, goodness knows, 200, 300 million, but we have a lot of support from institutional investors to go, and the government of India to go build it. And I feel really privileged to work with Dr. Ash Tiwari, who's one of the major cancer surgeons in the US, to build it out in India.
Wonderful. Sanjiv, I want to thank you again for taking the time. It's been a great conversation.
Thanks, RJ. Really appreciate the questions. Great questions, very intelligent and thoughtful. Appreciate it.